Did you know that in 2020, the stock market managed to evaporate a staggering 34% of its value in just 23 trading days? For most, it was a waking nightmare. But the most shocking discovery wasn't the crash itself. It was the list of people who performed the best during that chaos. A famous study by Fidelity found that their top-performing accounts belonged to two specific groups: people who had passed away and people who had simply forgotten their login passwords. It sounds like a dark joke, doesn't it? But there's a profound lesson here. While the rest of the world was frantically reacting, the people who couldn't do anything were the ones who actually won. Here is the hard truth. The very moment the market drops, your brain starts screaming at you to make decisions that feel safe in the moment, but do catastrophic, long-term damage to your wealth. In this video, I'm going to walk you through 6 specific, battle-tested moves that actually survive a market panic. These aren't just financial strategies. They are psychological firewalls designed to protect your money from your own human instincts. We're going to make sure you never turn a temporary market dip into a permanent financial setback. To understand why we fail, we have to look inside our own skulls. Most people think investing is a game of math and logic, but during a crash, logic isn't even in the room. A research team at Stanford's Neuroeconomics Lab made a chilling discovery. Financial losses activate the exact same region of the brain as physical pain, the anterior insula. This is the same area that lights up when you accidentally burn your hand on a hot stove. So, when your portfolio drops 30%, your brain doesn't see a number on a screen. It processes a threat to your very survival. Your nervous system reacts as if a predator is chasing you. It triggers one response: get out. Now. Don't think, just move. This is why even brilliant investors make devastating mistakes. Their rational software has been hijacked by an ancient biological system built for the savannah, not a 401k. The moves we are about to discuss work because they don't fight this biology. They account for it. Move 1. The Automation Firewall. The single most effective action you can take happens before the crash ever starts. You must remove your human self from the equation. Research from the University of Chicago's Booth School found that investors who automated their contributions during the 2008 crash ended up with 73% more wealth a decade later compared to those who tried to time their re-entry. It wasn't because they were smarter. It's because they never had to make a choice. By setting up automatic transfers, you turn a high-stress decision into a non-event. Automation doesn't require you to be brave. It just requires you to be prepared. Move 2. The Cash Buffer Zone. You need cold, hard cash. 6 to 12 months of expenses sitting in a boring, high-yield savings account. Why? Because researchers at Princeton discovered that financial scarcity reduces your cognitive function by 13 IQ points. That is the difference between being a high-functioning adult and being cognitively impaired. A cash reserve isn't just for bills. It's for protecting your nervous system. It gives you decision space, the room to breathe while everyone else is suffocating in panic. Move 3. The Rebalancing Trigger. During a crash, your 80-20 portfolio might shift to 60-40. Your brain will scream to sell stocks, but the rebalancing trigger tells you to do the opposite. Sell bonds and buy more stocks. It is psychologically brutal, but financially elite. Vanguard found that disciplined rebalancing added about 0.35% in annual returns. Over 30 years on a $500,000 portfolio, that is worth over $200,000 in extra wealth. Set percentage-based triggers so the system buys the pain for you automatically. Move 4. The income diversification moat. Market panics often bleed into the job market. The most destructive decisions happen when your portfolio drops at the same time your paycheck is at risk. A study from the NBER found that households with multiple income streams were 4 times less likely to make early retirement withdrawals. This is about strategic redundancy. Even a small secondary stream stops your brain from treating every headline like a terminal survival threat. Move 5. The anti-news protocol. During a panic, consuming financial news makes you literally poorer. UC Berkeley found that investors who checked media daily traded 40% more frequently, reducing returns by 1.5% annually. That gap can cost you $300,000 over a career. Crisis news is designed to activate your fear, not inform your brain. Delete the apps. Check your portfolio once a month. Being less informed during a crisis actually makes you a better investor. Move 6. The Opportunity Fund. This separates survivors from those who build generational wealth. Since our brains process losses 2.5 times stronger than gains, you won't want to buy when stocks are on sale. The Opportunity Fund solves this by deciding before the emotion arrives. It's a separate pile of cash designated solely for buying during a downturn. Harvard research shows that investors with a predetermined deployment strategy outperformed others by 3.2% annually after a crash. That 3.2% is the difference between retiring at 60 or 67. Systems over willpower. Look at these 6 moves. Not one requires a PhD or a crystal ball. They all do one thing. They build a system that protects you from yourself. You aren't weak for wanting to panic. You are simply human. The secret to wealth isn't more discipline. It's better systems. Work around your biology, not against it. Set up your automation, build your buffer, and let the system do the heavy lifting. Let me know which move you're setting up first in the comments. And if you want more content that makes finance make sense, hit subscribe. I'll see you in the next one.